Hi there, I'm Sir Rob's Voice AI. Today's topic is all about the accounting equation, a fundamental principle of accounting that forms the foundation of the double-entry bookkeeping system. It clearly represents the relationship among an entity's assets, liabilities, and equity, which is, the total assets is equal to the combined totals of the liabilities and equity. We will also learn that it is closely linked to the balance sheet or the statement of financial position, which makes the balance sheet the key to understanding the equation. We will look at the elements of the equation individually and learn that they are synonymous to the contents of the balance sheet. And finally, we will discuss the categories of accounts under each element as recommended by the Cooperative Development Authority, or CDA. As always, in the practice of accountancy, we should remember to be professional, perform effectively and efficiently, follow standards, and document our work adequately and properly. In the previous video, we learned about the different financial statements that entities prepare as the means to communicate to stakeholders, as accounting is well known as the language of business. These financial statements communicate the entity's performance and health, as well as its short and long-term profitability, among others. These are general-purpose reports that meet the regulatory and statutory requirements of government agencies such as the SEC and BIR. They are also designed to meet the needs of other stakeholders such as the owners or shareholders, creditors and lenders, and the investing public in general. Of these financial statements, the income statement is statistically the most read report, while the statement of cash flow is the most distributed report. However, despite their popularity, they can only remotely contribute to the understanding of the accounting equation. Among the core financial statements, the balance sheet may not be the most read nor the most distributed report. However, it is undoubtedly indispensable for a holistic view of the entity, particularly when analyzed alongside other financial statements. And for all intents and purposes, it is the most significant financial statement essential for a thorough understanding of the accounting equation. We learned previously that the two formats of presenting the balance sheet are 1. The report format and 2. The account format. The report format is structured vertically, with assets, liabilities, and equity listed sequentially, one below the other. This format is commonly used because it is easy to read and aligns well with modern reporting practices, especially in digital and printed formats. However, it does not show the right and left elements of an equation and their relationship to one another. The balance sheet in the account format presents the company's financial position in a horizontal layout. It is called such because of its resemblance in form to the T-account used in traditional classroom discussions. In this format, the assets are listed on the left side, while liabilities and equity are listed on the right side. This format is designed to visually reinforce the accounting equation, assets equals liabilities plus equity. So, while the account format may not be the most popular financial report, we will use this in our discussion of the accounting equation.
Elements of the accounting equation.
The first element of the accounting equation is assets, found on the left side of the equation. Assets are resources owned or controlled by an individual, organization, or business that are available for use at the entity's disposal. They are expected to provide future economic benefits, that is, contributing directly or indirectly to generating cash flows or other benefits over several accounting periods. The value of an asset must be measurable or quantified in monetary terms. Assets are important for 1. Operational needs. Assets are essential for daily operations, for example, cash for transactions, equipment for production. 2. Assets are also used for value measurement, which indicates the company's financial strength and ability to generate revenue. 3. Assets are useful as collateral for financing, for example, to secure high-value long-term loans. And lastly, assets are also useful for 4. Investment analysis, the result of which measures the entity's potential for growth and profitability. Let's say our entity has 100 million pesos in total assets. The second element of the accounting equation, found on the right side, is liabilities. Liabilities are obligations or debts that a company, organization, or individual owes to others, typically arising from past transactions or events. They represent claims against the entity's assets and are settled through the transfer of money, goods, or services in the future. Liabilities are the portion of assets funded by creditors rather than owners and thus represent a third-party claim on the assets. Liabilities are used for 1. Financing operations. Many businesses rely on liabilities, like loans or credit, to finance operations and growth. They are also used for 2. Liquidity assessment, which helps stakeholders, such as lending banks and suppliers, evaluate the entity's ability to meet short-term obligations. 3. Solvency analysis. Non-current liabilities help assess the entity's long-term financial stability. And lastly, liabilities are useful as an influence on equity, which means that an entity's liabilities affect the residual interest or equity available to owners after debts are settled. In our example, let's say our entity has 40 million pesos in total liabilities. The third and final element of the accounting equation, also found on the right side with liabilities, is equity. Equity represents the ownership interest in an entity after all liabilities have been subtracted from its assets. It reflects the residual value that belongs to the owners or shareholders and is often referred to as net assets or shareholders' equity in corporate contexts. The equity of an entity, 1, indicates its financial health. A positive equity balance indicates a surplus of assets over liabilities, while negative equity may signal financial distress. Equity can also be, 2, a source of financing, such as when an entity issues shares, providing funds for growth and expansion. Lastly, equity determines 3. Profit or dividend distribution, as the retained earnings within equity determines the ability to pay dividends to shareholders or distribute profits to the proprietor or partners. The accounting equation dictates that assets must be equal to the sum of liabilities and equity. Since we know our assets is valued at 100 million and our liabilities at 40 million, we can easily determine how much the equity is. We have 100 million on the left of the equation. To maintain equality, the right side of the equation must also be 100 million. We already have 40 million in the form of liabilities. Therefore, the remaining 60 million must be the amount of our equity. The equity accounts for a sole proprietorship and partnership are very similar, with only the capital and withdrawal accounts making up equity. Corporations and cooperatives have more complex equity sections because there are more accounts and account categories to deal with. Now let's examine how the accounting equation is affected by the performance of the entity and how balance sheet is connected to the income statement.
The income statement and how it affects the accounting equation.
Using the account format, the income statement may also be represented by a T account. However, the vertical line is further to the right. That is because, while the balance sheet has two elements on the right, the income statement only has one. And conversely, while the balance sheet has one element on the left, the income statement has two, as we shall see soon. So we leave more space on the left for income statement. Like the balance sheet, the income statement in the account format also demonstrates equality between the two sides of the equation. The elements revenue or income and expense and cost stay on the left of the equation, while the element profit or loss stays on the right. To form the equation, revenue minus expenses equals profit or loss. The first element of the income statement is income or revenue. Revenue refers to the total amount of money earned by a business from its primary activities, such as the sale of goods or services, during a specific period. It is often referred to as the top line because it appears at the top of the income statement. Revenue is a key indicator of an entity's operational success and market demand for its products or services. Revenue also represents increases in economic benefit. Every revenue transaction increases assets. Revenue may also include gains from activities not related to normal operations, such as the sale of some computer assets by an entity producing ice cream. The key characteristics of revenue are: 1. It arises from core operations, or the entity's primary activities like selling products or providing services. Other income, like gains from asset sales or interest earned, is categorized separately. 2. Revenue is measured and recorded over a specific accounting period, for example, from the first day to the last day of the current month, from June to August making up a quarter, or January to December of the current year. 3. Revenue may also be earned in various forms, such as in cash, receivables, or other economic benefits. There are only two types of revenue: operating and non-operating revenue. While operating revenue is generated from the entity's main business activities, non-operating revenues are earned from secondary activities unrelated to the core operations of the entity. Examples of non-operating revenues include interest income, rental income, and dividend received. When do we recognize revenue? Revenue is recognized when the following conditions are met. There is: 1. Performance of obligation, or in simpler terms, the goods or services have been delivered to the customer. 2. Collectivity. This means that there is a reasonable expectation that payment will be received due to the performance of the obligation. And 3. Contractual terms, or the transaction price is previously agreed upon and measurable. Under the accrual basis of accounting, which is the generally accepted accounting principle GAAP, revenue is recorded when earned, not necessarily when cash is received. Revenue is an indicator of business performance. For instance, revenue growth indicates increased sales or demand, while a decline may suggest challenges. It is also a basis for profitability, since revenue is the starting point for calculating profit after subtracting costs and expenses. And lastly, it is of significant item to investor and stakeholder. They closely monitored revenue trends to assess an entity's potential and market position. The formula for revenue of a merchandising entity engaged in producing or buying and selling of goods is price multiplied by the quantity sold. In a service entity, it is computed as the service fee multiplied by the number of transactions. Revenue is presented as the first item in the income statement. Compared with profit, revenue is the total income before any expenses, while profit or net income is what's left after deducting all costs, expenses, and taxes. Compared with cash flow, revenue represents income earned, while cash flow shows the actual cash received or spent. In summary, revenue is the lifeblood of a business, serving as the foundation for assessing operational efficiency, profitability, and overall financial health. In our example, we assume that for the current period, we earned a total revenue of 10 million pesos. The second element of the income statement are costs and expenses. These income statement elements represent a decrease in economic benefit. When incurred, they either decrease assets or equity, or increase a liability. Costs and expenses are usually paid in cash, either upfront or at a later date. However, there are also expense items that does not require outlay of cash, such as the depletion of assets, either through depreciation of tangible assets or amortization of intangible assets. Losses from activities not related to normal operations also become part of the total cost and expenses. Costs refer to the expenditures or resources consumed by a business to buy or produce goods, provide services, or operate its activities. They represent the outflows of economic resources incurred to generate revenue and are critical in determining an entity's profitability. In financial terms, costs are classified as expenses when they are directly tied to a specific accounting period or recognized in the income statement. The different types of cost include: 1. Direct costs. These are costs directly attributable to producing a specific product or service. Examples are raw materials and direct labor, such as the wages for workers in a factory producing the goods. 2. Indirect costs. These are costs not directly traceable to a specific product or service, but necessary for operations. Examples are rent for factory, shop or office space, and utilities such as water and electricity. 3. Fixed costs. These are costs that remain constant regardless of production volume. In fact, entities incur these even when there are no goods produced. Examples of fixed costs include rent and salaries for regular employees, such as the administrative staff. 4. Variable costs. These are costs that vary in proportion to production or sales volume. Examples of these include raw materials and packaging. 5. Semi-variable costs. These are costs that have both fixed and variable components. Examples are utility bills with a fixed base fee and variable usage charged on top of the fixed fee. The categories of costs that may be found in an income statement include the cost of goods sold, operating expenses, non-operating costs, capital expenditure or CAPEX, and period costs. The cost of goods sold represent the direct costs of buying or producing goods or services sold by the business. The formula to compute for this is opening inventory plus purchases minus closing inventory. Operating expenses are associated with running the business but not directly tied to production. Examples of these are marketing and administrative expenses. Non-operating costs are unrelated to the core operations of the business. Examples are interest expenses and losses on asset sales. Capital expenditures or CAPEX are incurred to acquire or improve long-term assets like equipment or buildings. These are not immediately expensed, but capitalized and depreciated over time. Period costs are recognized as expenses in the period they are incurred, regardless of production or sales. Examples are office rent and depreciation. Direct costs. These are costs directly attributable to producing a specific product or service. Examples are raw materials and direct labor, such as the wages for workers in a factory producing the goods. Understanding costs is crucial for analyzing profitability, as it helps determine the margin between revenue and expenses, ensuring that a business remains financially viable. It plays a key role in pricing strategies, enabling businesses to set prices that cover costs while maintaining competitiveness and profitability. Cost analysis also aids in cost control by identifying areas where unnecessary expenditures can be reduced, leading to greater efficiency. Additionally, a clear grasp of costs supports informed decision-making, particularly in budgeting, forecasting, and resource allocation, which are essential for long-term business success. On the slide is an example of costs on an income statement. Costs and expenses are related concepts, but differ in scope and accounting treatment. Costs encompass all expenditures incurred by a business, including those that are capitalized as assets, such as equipment or buildings, and those recognized immediately as expenses. Expenses, on the other hand, are a subset of costs that are directly recorded in the income statement within a specific accounting period, reflecting the outflows of resources tied to generating revenue during that time. In summary, costs and expenses are essential to understanding the financial mechanics of a business, as they directly impact pricing, profitability, and overall financial health. In our example, we assume that the total of costs and expenses is 7 million pesos. The last element in the income statement is profit or loss. Profit or loss represents the financial result of a business's operations over a specific period, calculated as the difference between total revenue and total expenses. It is a key indicator of an entity's financial performance and sustainability. The formula for computing profit is total revenue minus total costs and expenses. There is profit when revenues exceed expenses, indicating that the business is earning more than it spends, contributing to growth and shareholder value. On the other hand, there is loss when expenses exceed revenue, indicating the business is spending more than it earns, which may require adjustments to operations or finances. Profit directly affects the balance sheet. When there is profit, it increases equity, and when there is loss, it decreases equity. In our example, therefore, since we have a revenue of 10 million and costs and expenses totaling 7 million, we have a profit of 3 million. Profit or loss can be assessed at different levels, providing insights into various aspects of the entity's financial performance. Gross profit measures the profit remaining after deducting the cost of goods sold or COGS from total revenue, reflecting the efficiency of production or service delivery. Operating profit, also known as earnings before interest and taxes or EBIT, is calculated by subtracting operating expenses from gross profit, offering a view of the profitability from core business activities. Finally, net profit or net income is the bottom line and represents the profit after accounting for all expenses, including taxes and interest, providing a comprehensive measure of the entity's overall profitability. In summary, profit or loss is a fundamental measure of financial success, helping stakeholders assess the business's efficiency, viability, and potential for growth. How does the income statement affect the accounting equation? Earlier, we said that the profit or loss directly affects the balance sheet, specifically the equity element. Profit and loss directly impact the equity account because they represent changes in the entity's net worth resulting from its operations. Profits increase equity, while losses decrease it. This connection is primarily reflected in the equity element on the balance sheet through summarization of the total revenue and total costs and expenses in the income summary account. Also, we said that revenue always increases assets. Thus, at the beginning of the accounting period, our entity had 100 million total assets. Since the entity generated a total of 10 million revenue, this increased the assets to 110 million. Assuming that the entity paid for million of the 7 million total expenses in cash, this will reduce our total assets to an ending balance of 106 million. The entity's liabilities totaled 40 million at the beginning. Assuming that we incurred the other 3 million of the 7 million expenses with liabilities or obligations to pay at a future date, this will increase the entity's liabilities to an ending balance of 43 million. Thus, our net profit of 3 million will increase our equity from 60 to an ending balance of 63 million. Notice how the accounting equation is kept balanced across periods. Our total assets at the beginning equals the total liabilities and equity. After the period of operations, there had been changes in the balances because of the current transactions. However, accounting principles preserve the equality of the equation. The entity now has a total asset ending balance of 106 million on the left side of the equation. It now has 43 million in liabilities and 63 million of equity on the right side of the equation. The sum of the two equals the total assets at 106 million. And that ends our discussion of the accounting equation. We have seen that the account format balance sheet mirrors the accounting equation, and thus helps a lot to understand the relationship between assets, liabilities, and equity. We also have seen how the results of the operation of an entity for a certain period affect the amounts of the equation, and how the rules of accounting preserve the equality between the elements on the right and left of the equation. Thanks so much for watching. I hope you understand the valuable lessons here. I'm excited to hear what you think, so fire away your questions or ideas in the classroom. I'd love to hear your thoughts.